In this video, I'm going to break down how to avoid the next crash and what I would do and what I think everyone should be considering, to avoid the next crash when it actually does come, because a crash will come eventually. Remember, this is Quantime Research. This is not financial advice. This is pure education. Hopefully you take something from this useful, but don't just go and act blindly on what I mentioned here. I do have a free newsletter, so if you do want to keep up to date with markets, links to that will be in the description. Have a plan. Very easy, but emotion leads to bad decisions, and you don't want to be making bad decisions, and you'll lose money. Having a plan is one of the ways to remove emotion. So emotional decision making is the biggest cause of losses in a crash. People tend to sell the bottom. If you're selling the bottom, you just don't have a plan. It's that simple. You just don't have a good plan if you're selling the bottom. You should maybe sell, not the top, but maybe just before the ultimate crash. But you need to have a plan, because, if you don't, you're going to just put yourself at more risk, and you want to reduce your risk as much as possible. And actually having a plan is the best, risk management tool you can actually do. You don't need to be technical. You just need some conditions. So you don't need to be super technical with what you're doing. You don't need to be a good technical analyst, a good fundamental analyst, a liquidity analyst guy, a value investor. You just need to have rules in place when a significant structure change happens, a level lost or earnings change or inflation's this, whatever it may be. You tweak things a little bit, and that you build into your plan. The aim is to feel as close as to nothing as possible. If a 10 to 20% drop causes you real pain, you're probably overexposed. A good position, if you lose a bit of money or you sell at a loss, you shouldn't feel anything. You should think, okay, cool, that's part of the game, move on. So you've really got to be asking yourself, okay, cool, if I'm taking this loss, am I really going to feel it? Is it, or maybe not I'm going to feel it, is my portfolio really going to feel it, and my money, and so on? Am I going to put other things in my life at risk? If you feel pain at, minus, 10%, minus 15, minus 20, you're overexposed, right? So we need to really think about position sizing, because you can also be underexposed. Like you can also be your risk taking sentiment can be too low. So that's something you got to consider as well. But you want to feel close to nothing as possible, and you really don't want to be overexposed. You want to have that nice middle. I think you probably want to be, if there's a scale, because you don't want to be underexposed, but you don't want to be overexposed. I think you probably want to teeter, kind of maybe have a 40 to 60% zone you teeter in. So you kind of maybe are here at some point and you're here at some point, and you kind of want to go in and out. You never want to be fixed. You want to be flip flopping, but you never want to go too far one end. So that's what I would be suggesting. Be careful with leverage. We saw Leopold Aschenbrannen's fund, the situational awareness fund. Leverage is a capital efficiency tool. It's not a way to increase the size of a bet. So, look, unless you're Stanley Druckenmiller and you're going 200% leverage short of the British pound, for most people it should be a capital efficiency tool. It should be, okay, cool, I want to leverage this more because I don't have the money in this area, because my money is here at the minute in a different bank account, let's say, for example. So, you don't want to be, leveraging too much, because leverage does risk the, size of your potential losses. So you want to understand leverage. It's typically a capital efficiency tool that you want to, put on, because you don't want to have all your money, let's say, on an exchange, for example, or you don't have your money in a certain account, or you have your money in multiple accounts. So you want to do that. And if you have no leverage, I think there's a Charlie Munger or Warren Buffett quote. I think it's Charlie Munger. Most of the things that destroy men, ladies, liquor, and leverage. So really get an understanding if you're going to use leverage. If you don't understand leverage, don't bother using it. Because look, with forex leverage, a 25% drawdown can be a 100% loss, right? So really consider these things as well. And in a crash, leverage forces you to sell at exactly the wrong time. So capital efficiency means doing more with less. So really kind of understand that if you're going to use leverage. If you don't understand leverage at all, don't bother. If you don't sell, you don't lose. So this is actually quite an important thing to know. If you didn't sell in various crashes and you just held on because that's your plan, you don't lose. So you should actually, if you're a 30-year investor and there's a crash, you should look to just buy. You should look to buy. All right? unrealized losses are not losses until you sell or close the position, right? So you've got to really understand that, if I don't close the position, I don't lose. Now, you don't want to get in the habit of, let's say you open a position on an individual stock, let's just say Berkshire Hathaway. Warren Buffett steps down as CEO of Berkshire Hathaway, and you said to yourself, when Warren steps down, I'm going to sell, all right? The stock drops, when it did when he stepped down. You're going to say, I'm going to carry on holding to the stock, why not? And let's just say, for example, it keeps dropping. And if you say, this is a great place, and that blah, 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 your plan is now over. The trade for you is done. Warren stepped down as CEO, so you should be out of that stock. But if you keep holding down, you're just going to average down your loser, all right? And that doesn't follow your plan. So that's definitely something to consider as well about the unrealized losses stuff, because there is obviously two sides to it. A lot of future millionaires are made in crashes. So I've got there 2008, 2020, 2022. A lot of crashes made generational wealth for many, normal individuals. The plan tells you when to not sell as much as it tells you when to sell. So yeah, as I mentioned earlier, if your conditions have not been triggered, you're not supposed to act. So even if you feel really fearful and so on, you want to sell, but your plan's not finished, the thesis ain't finished, you don't do anything. But before this, would be really interested to know, because if you're a 30-year investor, you shouldn't be worrying about anything in the next, 29 years. Shorting is not the answer. Don't be a hero. Yes, you can short. Yes, it's fine. But being right about a crash does not mean you're going to make money shorting it. I think that's a really important one to know. There will be bear market rallies. There will be short squeezes. Most people, maybe their capitals may be better longing. So the risk to reward of, shorting is fundamentally worse than being long. A stock can only fall 100%. It can rise 200, 300, 101%. So the upside for shorting is capped. A downtrend is not. So that's really important to recognise. Timing a short requires being right twice. The entry and exit. So I've done a lot of back testing on shorts, and what I found on the higher time frame, you can be great with the entry, but getting out is quite difficult because you'll just get a squeeze and you'll just lose a lot of the money that you could have made. So reducing exposure and waiting is also always better than shorting. And it's also a position is having no position. So having cash and all that stuff is still a position. So understanding those things as well is definitely a way that will help you navigate a crash. The chart will show you before the headlines do. So obviously I'm a technical guy, so you don't need to predict, you need to recognize. So conditions change on the chart before the narrative does. So think of monthly EMAs, yearly structure, relative strength across assets. Watch these, not the news. You'll get, you need to generate your own alpha. You can't react to the news. You can't make big decisions off the news, otherwise you'll always be late and it will just never end well. The 2022 stuff was, it was visible. It was there on the monthly charts. It was there on weekly charts. The headlines, though, calling it a bear market when it's in June, the trade has probably already been done. Everyone was extremely bearish on Bitcoin, I would say, around June, July time. Well, the bear market trade's probably done when that's happening. Or, maybe it's just going to chop around and do nothing for a while. But that's definitely something to consider. So when all major assets are rolling over at the same time, something, systematic is happening. So you want to be, you want to be managing the downside as much as possible, because when stocks, crypto, commodities decline together is a different signal to one sector pulling back. So you want to look out for, is everything pulling back? Is it mixed? You want to look out for those things as well. And it is typically baked into the charts before the drop. If you look at 2008, the markets were bearish for ages, but 2008 happened way before it does. It's always a good example. COVID's a bit different, a bit of a flash crash, but there was still weakness on the daily before the big weekly drop, right? So these things are all baked into the chart way before they actually happen. So the verdict, have a plan. That's it. It doesn't matter what you do. I don't care what you do. Just have a plan. Aim to feel as close to nothing as possible. It's hard to not have any emotions, but you've got to have a plan. Be careful with leverage. If you don't understand leverage, don't bother. And if you don't sell, you don't lose. But you don't want to be, averaging down your losers. If you've got a plan and the thesis is done, the plan's done, you sell. And remember, shorting isn't the answer. If you want to keep up to date with markets and navigate the next crash, whenever that may be, I would talk about it in my free newsletter. Link to it will be in the description. See you in the next one.